It's a video for the Chapter 10 review formulas. I'm going to go through the formulas real quick. Then we'll probably do a little bit of the review packet. Also, at the end of the video, probably do a little bit just to make sure, to help you with the review packet. A little extra so that you can skip through stuff. You don't have to watch the whole video. Just if you're having trouble with certain problems, maybe go through the video and use it. First one, mortgage. When we dealt with mortgage, the amount of the loan that you financed is the selling price. So whatever, if you're paying $200,000 for the house, it's that selling price minus the down payment. The down payment, you take the percent, so it'll say like 20% or 30% down payment. So you take 30% times whatever that selling price is, and you got to subtract that off. So it's selling price minus the amount of down payment. But you'll probably have to find the down payment. Sometimes they'll tell you the down payment's $20,000 or whatever, but sometimes you'll have to multiply it to find it. Closing cost. Most of the time on closing cost, all it was you adding up everything. Now there was some for closing cost. Some of them say, like 2% of selling price. So you'll have to change that to a decimal 0.02 times whatever the selling price was, and then that answer gets added into the closing cost. So you'll have to look at that. They'll give you a list, and if it gives you a percentage of the selling price, then you got to add that in, or you got to multiply it first, then add it in. The points, don't worry about the points. There's not really anything on the test about points, but do remember that those are mills, and we'll talk about mills here, no, those aren't mills, sorry. That's something different. So don't worry about the points. Formula to determine the monthly payment. There's a couple of problems on the test where you use you could use the big formula, or you could use the chart. There's a couple of problems on the test that give you a chart to use, and all you do is the amount of the mortgage. So you got to be careful with that, because the amount of the mortgage, that's not the selling price of it could be, but doesn't have to be. That's the amount that you're actually financing. So you would subtract off the down payment first. You take that number divided by 1,000, and then on the chart it'll say, like, you're doing a 7% loan for 20 years. Well, then you look up a number on the chart using those two numbers, and that's the number that goes here. So you take the amount of the mortgage. If you're financing $50,000, and you take 50,000 divided by 1,000, and then you times it by the number from the chart, and that's going to give you your monthly payment, how much your mortgage is going to be each month. When you know the monthly payment, you can calculate the total amount paid over the life of the loan by using this formula. So if you know your monthly payment is $1,500, then all you do is times that by however many payments you're going to make over the life of the loan. So if you take out a loan for 20 years, then to find the total number of payments, you just take 20 times, and you make a monthly payment, so it's 20 times 12, so that'd be 240. You multiply those two together, that gives you the total that you're going to pay for that home over the entire life of the loan. Once you have that, you take that amount paid, and there's a few of these problems on there. They're not really all that difficult. They seem a little hard. You take that amount paid, and you subtract off the amount of your mortgage. So whatever that number is that you just got from this problem up here, from doing that work, then if your mortgage amount, the amount that you took out in loan for the house was $125,000. Then you subtract those two, and that'll tell you the total interest that you were charged over the life of that loan, whether it was for 20 years, 30 years, 15 years, however long the loan was. This is the big formula that we used to find the monthly payment. This is probably a little more precise than the other formula. With this big formula, just remember that P stands for principal. That's how much you're actually taking out for the loan. Your rate, they're going to give you a percentage. It might be like 5%, but you got to remember that for the R and these, we want that 5% divided by 12. So everywhere you see R, you're going to put in whatever the percentage is divided by 12, because you want percent per month, not per year, but per month. So you got to divide each one by 12, and then N is the number of payments over the entire life of the loan. So if you're if you're taking it out for 20 years, it'd be 20 times 12. If you're taking it out for 30 years, it'd be 30 times 12, so on, so on, so on. And you just plug into that formula. Again, when you do this formula on your calculators, do what's in the parentheses first. I think we came out with a better way to do it, but I can't remember it right at the moment. But if you just do what's in the parentheses here, then this, remember, use the caret button to take it to a power, then multiply times the R, then times the P, write down that answer, whatever answer you get on top, write down whatever answer you get on bottom, and then divide the two. And that'll give you your monthly payment. And you should be able to tell if your answer makes sense or not as you're doing it. Allocation of a monthly payment, where your monthly payment actually goes to. This first one, there seems like there was 2 or 3 problems, 4 problems, 5, I don't know, on the test that deal with this, the interest that you pay per month. Remember that if you're making a $1,500 monthly payment on your mortgage, a whole bunch of that, when you first start off the loan, a whole bunch of that goes just towards interest. So a whole bunch of it just goes towards the interest. That interest, it might be something like $900, $1,100, something might go just towards interest at the beginning of your loan out of that $1,500. So to figure out the interest that you're paying out of each monthly payment, you take the principal, that's the amount of your loan, so it might be like $125,000, times the rate, that's going to be your percent that you're paying, I don't know, 5% or whatever it is. And then your time has to be 1/12, because we only want for 1 month. So you multiply this number times this number, and then hit equals and divide by 12, and that'll give you the interest that you pay for that month. The amount that went to the actual loan or to the actual principal, you take the answer that you got from up here, and you subtract it from what your actual monthly payment was, and that'll tell you how much of it went to principal. How much of it actually went to pay off your loan, and not just the interest that the bank or the loan company is charging you. The new principal, to get the new principal, you take the payment to principal, it goes in here, and you subtract it from your previous balance. So I think all of them on the test just go for like 1 payment. So your previous balance would be what you started with. So it might be something like $125,000 minus whatever answer you got up here in this second part. The assessed value All you do to find the assessed value is you take the market value, they'll probably tell you that, times the rate of assessment. It's gonna be like 75% or 50% or whatever, it just depends on what you're using it for. If you're using it for taxes, then, you know, it's a value that the county or the city or whatever sets up. Your real estate tax, your tax rate, times the assessed value. So you take this value, stick it in there, and that's gonna tell you how much real estate tax you're gonna pay. Remember that percents, or percent, you bump the decimal. So if you have 5%, you bump the decimal 2 places to the left for percents. For mills, you bump it 3 places to the left. So if they say your tax rate is 1.2 mils, then when you change that to a decimal form so that you can multiply it, you bump it 1, 2, 3, and you end up with a 0 there, 0 there, so it's 0.0012. So mils are bumped 3 places over instead of just 2. And mills are usually used with some kind of tax. The amount of coverage on your home, your replacement value, they'll probably give you that, times the insured percentage. So you can insure the house for 100%, 90%, 80%, 75%. The smaller the percentage is, the cheaper that your insurance is going to be. So that's why you wouldn't always cover it for 100%. So you just multiply those two. If it's 80%, then remember you multiply by like 0.80, whatever the replacement value is. You take that answer, put it in here, and you times it by the percent covered. There's only going to be a certain percentage covered, like on your personal belongings, maybe on the garage or on whatever. So you multiply it, you'll have some other percent here, and it might be like 40% or something. And you multiply that times that, and that'll give you the amount of coverage on those certain items, whether it's personal belongings, garage, cars, whatever else you might have covered. Your average monthly cost, total annual cost divided by the number of months. You gotta be careful here. Sometimes they'll tell you the annual cost. Remember that annual means per year. Sometimes they'll throw in a monthly cost, and if they throw in a monthly cost, you have to multiply that times 12 to get an annual cost before you add it into this. And then you divide by the number of months. The number of months normally that we use is normally going to be 12, and that's going to give you your average monthly cost. But again, you have to be careful. Make sure you know which items are annual, which items they give you the cost as far as annual goes per year, and which items they give you the cost per month. Like if they just tell you the rent is $600, well then that's a monthly cost. So you'd have to take that times 12 to see how much you pay annually. And then you can add that in with all the rest of them, then divide the total by 12. All right, I'm going to run through and do a couple of these problems off of the review packet. We'll just start with number 2. Says, Adam is purchasing a home, $189,000. Bank is willing to finance the purchase if Wilcox can make a down payment of 1/4. Well, we need to change that to a percentage. That'd be 25%. So he's got to make a down payment of 25%. How much money will he need for his down payment? So it's $189,000. And we bumped this over 2 places, so 0.25. We multiply that, and we get 47,250. That's the amount of his down payment. That's the answer that they wanted on that one. Number 3, Linda is planning to buy a rental property. She finds a home priced at $92,000. What is the amount of Griffith's mortgage loan if the down payment of 10% is required? So the first thing we got to do on this one, 92,000 times 0.10, that's to get the down payment, which is, we grab our calculator, that's $9,200. Then you take that 92,000 and you subtract off the 9,200 for the down payment, and that's going to tell you how much she actually has to finance, how much she has to take out for a loan, and it comes out to be $82,800. That's the answer. Skipping down to number 5, says Fred and his brother are interested in purchasing a house priced at $310,000. They plan to put 30% down and finance the remaining through Anderson Savings. Anderson Savings has the following closing costs, and they give you a list of all the closing costs there. I'm not going to read them all. If the loan is approved, how much cash will Fred and his brother need to secure the loan, including the down payment? So we're going to take the down payment and all the closing costs, add them together. That's how much money they have to pay the bank when they go in to get the loan. So the first thing, find the down payment. The house is $310,000. They want 30% down, so that's 0.30. We're going to times those, and we come up with 93,000. So they're going to need $93,000 for their down payment, plus $100. These are all the closing costs that they listed up there, plus another $250, plus $190, plus $275, plus $70, plus $280. And all we're going to do is add all those up, and when we add them all up, it comes up to $94,165. Number 6, we'll do number 6, that's using the chart. Says use figure 10.1. Tim purchased a home priced at $186,700. They put $28,005 down and financed the rest at 7% for 20 years. What is the amount of their monthly mortgage payment? So just looking at that, first thing we're going to do is we're going to take the cost of the house, which is $186,700, and we're going to subtract off their down payment, which was $28,005. So this time they just told us the down payment instead of giving it to us as a percentage, so we didn't have to actually find it. And that comes out to be $158,695. So this is the amount that they actually had to finance. Then we use the chart. If you go up there to the chart, and we're looking at, they said 7% for 20 years. We look at the chart and we go down to 7% and we go over to 20, and the number that they give us in that chart is 7.75. And then the formula is the cost, the amount financed, over 1,000 times the number from the chart, which is 7.75. And this is gonna tell us their monthly payment. So we punch this into our calculator. When you punch it in, you just do this number divided by 1,000, hit equals, and then hit times this, and it gives you, somewhere close to, it gives you about $1,229.93. So that's their monthly mortgage payment. And it's, that answer, if you rounded it off a little different, depending on how you rounded this off as you were going through it, but you're close to that. Sorry, we're not doing number 7. Jump down to number 9. Says April and her sister obtained a 25-year, $120,000 loan on their new home. The interest rate is 7.5% and the monthly payment is $886. How much of the first payment is to principal? So what we got to do on this, first thing we got to do is figure out how much of the monthly payment went to interest, and the formula for interest is that I equals principal times rate times time. The principal is the amount of the loan, which is $120,000, times the rate, which they told us was 7.5%, so we bump that over 2 places, 0.075, time, we only want 1 month, so it's 1 divided by 12. When you punch this into your calculator, punch in 120,000 times this number, hit equals, and then just hit divided by 12, and that's going to tell you how much of that first payment went to interest. And when I punched all that in my calculator, I come up with $750. That's not our answer. That's how much went to interest. To figure out how much of it went to the principal, we take that number and we subtract it from how much they actually paid per month. And let's see, their monthly payment was $886. And we subtract off the $750. This is the part that went to interest. And we come up with $136. So of that $886 that they made a payment on, 750 of it went to pay the bank or whatever it is, and then only $136 went to the actual loan payment. But that 136 is your answer. And I'm going to skip over some other problems. So the other thing that you might do here, that's the answer to this problem. But the other thing that they might ask you for is, what is their new balance? If we wanted to find the new balance on their loan, we would take the amount of the loan, which is $120,000, and we would subtract off the amount that they paid to the principal, which was at $136, and that would give us their new balance. Number 10, Dan has been granted a $120,000 mortgage loan. When signing the papers to purchase his new home, he will need to pay the closing cost shown below. What is the total closing cost? To find these total closing costs, you're going to add all of them up. Now you notice that some of them are percentages, so we have to figure those first. And so what you're going to have to do is, if you look down through there, there's a 2% of the mortgage. So you take 0.02 times the amount of the loan. Well, the loan was $120,000. And that, when I do that on my calculator, that's $2,400. And then you got to be careful on those two at the bottom there in the chart. The one says 0.30%. We still bump that over 2 places. So that actually comes out to be 0.003. And and you can put that other 0 on there at the end if you want. So we take that number times the 120,000, and that gives us $360. And then the other one's 1.25, so that's going to come out to be 0.0125 times 120,000. And that gives us 1,500. We're going to add all 3 of those plus the rest of them in the chart there, which was 25, 65, 350, 215, 450, and 400. We're going to add all those up. That's going to be your total closing cost. And when I add them all up, I come up with 5765. So that's the total closing cost. I'm not actually going to do number 13, but number 13 is a problem just like number 9, except at the end you got to subtract off the amount that went to principal to get how much it is. I showed you that on number 9. Let's jump to number 15. Number 15, the Butler County Tax Assessor determined that the market value of Greg Wilson's home is $123,000. The rate of assessment in Butler County is 28% of the market value. What is the assessed value of Greg's home? On this one, all we do is take 123,000 times 28%, so times 0.28. Multiply that, and you end up with $34,440. So that's the answer, and that's what they're going to charge him taxes on. 16, just to show you something about 16, says Amanda says assessed value $74,200 on her home. The tax rate where she lives is 25.13 mils. So at 25.13 mils, we got to bump that over 3 places. So it's 0.02513, and we times that by the $74,200. And when we multiply that, we end up with something that looks like 1864.646, and we're going to round that off to money, so this here is going to be 0.65, and that should be our answer. Looking at 17. Use figure 10.3. Julie's home is insured for 90% of its $100,000. So normally we'd have to take the 100,000 times 0.90, but they've already done it for you, and they tell you that it's $90,000. So her home's insured for 90,000. We look up there at the chart, and let's see, what else did it tell us? It says it's a wood frame, and it's rated class 8. So we look at 90, go down to 90,000, go over to wood frame, class 8, and it says 296. So her insurance will cost her $296. Number 19. Says Christine Tina has insured her home for 80% of its replacement value. The value is $155,000. Use the chart below to determine the coverage on personal property. First thing we have to do here is we have to take the $155,000. She only covered it for 80%, so we got to take that times 0.80, and that gives us $124,000. That's how much coverage she has on her, on everything. Then 45, we look at the chart, 45% of that's on personal property. So we take 124,000 times 0.45, and that gives us $55,800. So she's got coverage for $55,800, up to $55,800 on her personal property. Number 20 says Lisa plans to rent an apartment for $1,090 per month. She estimates her annual expenses will be as shown in the chart below. What's the average monthly cost? So on this, notice in the chart it tells you everything annually. So what you need to do, that's annual, but the rent is monthly. So there's a couple different ways you could do it. What I'll do is I'll add up the whole chart. If I add up all those numbers in the chart, I come up with $5,475. That's all annually. So we want to divide that by 12. When I divide it by 12, I come up with $456.25. Now that's not our answer because we still have to add on the rent per month, which is $1,090. So we add those two together, and each month that apartment's going to cost her about $1,546.25. That's her monthly charge. The other way you could have done it is you could have multiplied this times 12, added it into that, and then divided it all by 12. Either way, it's going to give you the same answer. Look at 23. 23 says Tina and her husband are buying a $219,000 home. Their annual housing expenses are mortgage payments of $15,400. So they're giving you all of this per year, and it's got a list of everything there. The lost interest on the down payment is $1,001, and the tax savings is $1,976. The only thing that I wanted to mention on this one, when you're adding all these up, again, they're all annual. So if you need the monthly cost, then you have to divide the answer by 12. And the last thing I wanted to mention here is it says there's savings on taxes. Well, that's going to get subtracted off. So that number there, you got to watch, it gets subtracted off. And when we do all that, I come up with a total of $27,100. Well, they want the monthly, so we have to divide that by 12, and it comes out to be about $2,258.33. And that's our answer. The matching, often expressed as mills. I'll just run down through these real quick. Often expressed as mills, that's your tax rate. $25 protects you as a homeowner from accidents caused by negligence. That's your personal liability coverage. Personal liability coverage. 26 may include fees for the property survey, loan applications, and points. That's the closing cost. 27 pays for hospital expenses and for non-family members injured on your property. That's your medical coverage. Medical coverage. 28 pays for expenses for living away from home while your damaged home is being repaired. That's loss of use coverage. Loss of use coverage. 29, a percent of the property's market value that is taxed. That is the rate of assessment. Rate of assessment. 30, the price to buy or sell a property. That's the market value. Your market value. And 31, the dollar value assigned to a property for taxation purposes. That's the assessed value. Thirty-two, we're using that big long formula. On 32, in that formula, your principal's $175,000. Your rate is 5%, so 0.055, or 5.5%, sorry, 5.5. And we're gonna actually, when we stick that in, we're gonna divide it by 12. And your N is 25 years times 12 times 12 months, which gives us 300. So when I stick everything in this formula, I'm just going to write out the formula. That's 175,000 times 0.055 divided by 12 parentheses 1 plus 0.055 divided by 12 raised to the 300 power. And then on the bottom it's 1 plus, ignore that, 0.055 times, or divided by 12 raised to the 300 power minus 1. When I plug all this into my calculator again, plug in this first, then hit +1, then hit equals, then hit the little caret button, the 300, hit equals, and then hit times 175,000 equals times 0.055, it equals, and then divided by 12, and it should give you something that looks like 3162.351144, some big long number like that. And then on bottom, you're going to do the same thing. You're going to type in this first, then +1, then the little caret button to 300, hit equals, and then subtract 1, and it gives you something like 2.942671556, and then you're going to divide those two. And when you divide them, it comes out to something about $1,074.65. That's our first answer. That's your monthly payment. That's your monthly payment. Then for the rest of the answer, to find the total amount that you actually paid for the house, after all the loan is over, you take that number, how much you paid per month, and you times it by how many payments you made, which is this N right here, the 300. And I come up with $322,395. That's our second answer. And then to figure out how much of that we paid was interest, we take how much that house, or we take how much we actually paid for the house, the $322,395, and we subtract off the amount that we actually paid for the house, which was $175,000. And that comes out to be $147,395. So that's how much in interest we paid for that house. Those are your three answers. $33, now I'm not going to do 33, I'm just going to show you to figure out, they're saying 35%, so we just take that number times 0.35, and that's going to give you your answer. 34, we did a couple of problems like 34, you got to figure out your interest, that's I equals P times R times T, remember T is 1/12. Figure that out. That's going to tell you the amount that went to interest on that first payment. Then to figure out the amount that goes to principal, you take your monthly payment minus this answer, and that's going to tell you how much of it went to principal. Then to figure out your new principal or your new balance, you take the original principal, which this time was $210,000, and you subtract off the answer that you got right here. $35. Rebecca Cruz earns $4,904 per month, and she bought her just bought her first house. Her monthly housing expenses include, and they give you a big long list there. What is the total amount of monthly housing costs? So first thing we're going to do is we're going to add all those up. Looks like $795 plus $37.75 plus $45.25 plus 54 plus 23 plus 21, and that gives us $976. So that's our first answer. And then it asks, does she stay within the 35%? Well, she earns $4,904, so we have to take that times the 35%. And that gives us $1,716.40. And then we just compare these two. These are her costs. This is how much she could spend. And the next thing they want to know is, are the costs less than what she could spend? And the second part of the answer then is yes. 36, you're just adding all that stuff up, seeing which one's cheaper, whether it's cheaper to rent or cheaper to buy the house. All right, this last part here is just, this is my key to the review packet. Use it, help you out. I showed my work on all of it. So I'll just try to scroll through this slowly so that you can see it. If you need to pause the video, then do that. I'm not going to talk about it a whole lot. I talked about the problems in the previous stuff, but this will show you, what you do for each problem, the steps and everything. Hopefully that helps you.